So are you looking for a financial advisor? The titles can be confusing. They all sound the same. You'll hear the title financial advisor, wealth management advisor, investment advisor, financial planner. Based on my experience, I would categorize advisors into three main categories: insurance advisors, commission-based advisors, and fee-based advisors. Unfortunately, how an advisor is compensated tends to impact the conversation with the client. So let's back up. Most insurance-based financial advisors are paid by commission. They're selling insurance contracts of various types. Driven by how much they are compensated, selling an insurance contract becomes their goal. They lead in with the guise of financial planning. They address risk management first. This is all driven by the need to obtain an upfront commission based on the sale of a contract. While insurance is important, it is dependent on the circumstances as to whether it's truly needed or not. Writing an insurance contract should not be the advisor's primary goal. Various forms of permanent life insurance fall into this category. These can include whole life insurance, universal life insurance, variable life, universal variable life. There are a lot of salespeople promoting the sale of these products. Advisors are paid very high initial commissions. Commissions can range anywhere on the low end, 60-65% of the first year premium. So I've seen contracts that are in excess of 100% of the first year premium. As such, they're very attractive to the salesperson, and it impacts their decision making. Correspondingly, it impacts the client conversation. Think sales pitch and you'll know the feeling. Most annuities fall under the commission-based advisor. There are many types of annuities. They're written in contract form. Most are more than 50 pages long and have an associated CDSC, or contingent deferred sales charge. The CDSC is a fee for surrendering all or a portion of the contract prior to the expiration of the CDSC schedule. Now, there is a 10% exception to that. We actually use that as a way to get out of contracts, but generally anything above the 10%, the CDSC is going to apply unless the scale is expired. I've seen applicable CDSCs, or contingent deferred sales charges, it was in excess of 19%. In that case, the annuity company had termed that as a bonus CDSC. So you're literally were paying more and they termed it as a bonus. The language in an annuity is not standard. It will usually have its own glossary of terms. Many are very difficult to understand. A recent version I reviewed, which was an equity indexed annuity, the annuity was in excess of 80 pages long. It did not even include the methodology for calculating performance. Now, it was 80 pages and did not even tell you how you incurred a gain. It did not provide the calculation for how you incur a gain. It required that you refer back to the document that was filed at the state insurance board if you wanted to know how your performance was calculated. Insurance contracts are like used cars. Once you drive it off the lot, you own it for better or for worse. This brings us to the commission-based advisor, which is also known or to follow the suitability standard. I'd classify this second type of salesperson as the commission-based financial advisor. This is an advisor that receives an upfront commission for selling mutual funds. Initial commissions for a mutual fund can be on the as high as 5.75% for an A-share mutual fund. I've seen other types of investments, commission-based investments, that the initial sales charge was up to 10%. A commission is subtracted from the initial amount invested. So if you invested $100 into an A-share mutual fund that had a 5.75% sales charge, you're actually investing $94.25. To help cover up this fact, I've seen advisors change the performance start date of an account to be the day after the funds are invested. This way they didn't have to show the impact on the performance report of that initial sales charge. If they did, it would be negative almost 6% from day one, but they were literally, now granted, that's not ethical for them to do that, but it's what happens in the industry. To understand this type of advisor setup, it's important to understand the concept of a share class. Fund companies create investment products which consist of a specified group of companies. So think about, it could be 20, 30, 40, could be hundreds of companies in a fund. It can also be in the form of bonds, or it could be a combination of the two. But then a fee structure or operating fee is applied by share class. Operating fees are separated into categories. You have management fees, which is the cost of selecting the investments. Then you have 12B1 fees, which is a distribution or service fee that is paid to a broker dealer. So those are fees that are paid directly back to a broker dealer. Then you have other expenses, which are, they don't define other expenses, but I believe those are sales costs of marketing the fund to an advisor. The operating fees are completely separate from the initial sales charge. So that we're talking about two distinct things. The fees are totaled and subtracted from the investment performance of the underlying holdings. So you don't explicitly see the fees. The greater the fees, the lower the net amount of the investment performance. On your screen, you can see an example of a summary prospectus from the Growth Fund of America. The prospectus is available via the fund company's website. At the bottom of page 1, you can see 21 different share classes. So just let that sink in for a second. 21 different share classes. The total annual fees vary by share class from a low end of 0.3% to as high as 1.44%. So depending on the marketing channel or where you purchase the funds, the fees can vary greatly, and again, for the exact same underlying holdings. So let's recap. Management fees are the cost of the fund company to select the investments. So picking which investments are going to be inside the fund. The 12B1 fees are paid to the broker-dealer, which in turn passes along a portion of the fee to the advisor. The 12B1 fees range, most are at 0.25%, C shares are at 1% annually. And then other expenses, again, not defined, but they add to the total fund expense. Then you have the sales load, which is charged or subtracted from the amount that you're investing. So that's an expense that is incurred before you're actually invested. It's subtracted as the funds are going in. Commission-based advisors receive a portion of sales loads and of the 12B1 fees. These are paid to the corresponding broker-dealer, and then that is, again, it's split by the compensation agreement that the advisor has with the broker-dealer. As such, depending on the account, this brings us to fee-based advisors, also known as fiduciaries. A fiduciary seeks to minimize conflicts of interest. They must put the client's best interest before their own and act in good faith. In this setup, the investment advisor receives a fee for assets under management. The fee is deducted from the client accounts at specified intervals, usually monthly or quarterly. The fee is separate from the investments. This gives the advisor the ability to move from one investment fund family to another without any consideration of fees. There's not any sales loads. The fees are not impacted by moving from one company to another. This eliminates the question, is the change in the client's best interest or the advisor's? Because both are on the same team. Sales loads do not apply. 12B1 fees do not apply. The client is the sole source of payment to the advisor. There are no payments from investment companies to the advisor or the advisor's firm. Again, the client pays the advisor. The fees are deducted from the corresponding accounts. It's important to understand that the underlying investment tools, mutual funds, ETFs, etc., have a lower fee structure than their corresponding broker-dealer commission-based counterparts. This can be seen very clearly in a fund prospectus. However, very few clients read a prospectus. Simply put, the commission-based advisor uses different investment tools than a fee-based advisor. Apples to apples, the fund fees will be lower and the sales load will be eliminated. The fee-based structure is cleaner, simpler to understand, and since churning incentive is removed, compliance is simpler and creates a lower cost structure for the advisor. To make things a little more complicated, some advisors are dually registered. Dual registration means that the advisor sells both commission-based funds and can manage fee-based accounts. In my experience, this can create confusion for the client. It can be difficult to know which rules apply to the accounts in question. I've seen many clients with both types of accounts managed by the same advisor. Okay, I hope this helps you navigate the world of financial advisors. Good luck.